let's get started. Mr. Barry Whelan, good morning to you, and
Good morning.
introduce yourself and tell us a bit about you.
I suppose, look, my name is Barry, obviously I've known. Thanks to everybody for coming this morning. I'm a financial planner, so what does that really mean? I help people with the likes of their pension funding, with savings and investments, and also the likes of life cover, serious illness cover, business cover, a lot of things. So anything really financially is where I'd help clients. I suppose a little bit about myself and what kind of helps me in my career. I suppose I would have started out in a family business, which obviously, unfortunately, would have closed down in 2008 with the economic downturn. And then I would have went into a niche area of tax, specifically research and development, basically just helping companies claim the tax incentives that are available on research and development. So I suppose going from a family business to a very small niche tax consultancy up against the likes of the Big Four, which ultimately then was kind of funny because I ended up moving into Big Four company in Deloitte. So they would have bought over that company. So we went from the small David versus Goliath type scenario to being in a massive multinational corporation. I suppose at that stage, then I took a big change, still staying within financial services, but as a financial planner, would have started out then on my own as a tied agent. So I would have went through the self-employed model. And then from that, 4 years on into brokerage. So I suppose the likes of those experiences being in the family business, the multinational, being self-employed, I suppose I can empathize with clients. I understand what they're going through. And I suppose using those experience to help me, not only my professional knowledge, but also my life experience. I think it definitely helps clients. I do understand a lot of the situations, I suppose, in different employments and different employments people are in. I suppose that's been hugely beneficial to me in my career.
And I think that's a really good point, because people like to, I suppose, develop the rapport with somebody who's especially somebody who's managing their money and their investments. So to have somebody like yourself who has such a diverse range of experience within that profession is I think it's really beneficial. It would, I suppose, add a lot more peace of mind to somebody like me if I knew that you had that experience, not just from a family business, but from the multinationals.
I get to share all the mistakes I made as well.
Yeah,
which is great.
Yeah.
I suppose, and the family business, could we move more money out of the company into like a pension funding, being self-employed? I know the headaches that come with that. I'm kind of going, God, I need to fund my pension, and you're worried about retirement and you have the overheads of today. Yeah. I've been in those situations, and I can really understand and not just empathize. I've been through those problems myself.
Yeah. And did we really learn lessons from the last recession? Did we? Or are we kind of going through the same mistakes again? Or are people more prepared and wary? Or what do you think?
I think that people are more savvy, but I think we have kind of lost the run a little bit again in the likes of buying new cars, and maybe people overspending on the likes of that. I mean that's everyone. It's each to their own, though. In that regard, but you can definitely see it in, have we forgotten lessons? I suppose one of the lessons I learned from the last one was really planning my finances in the short, medium, and long term.
Yeah, that's a really good point. Yeah, really good point.
The short term's day to day. That's going to be your expenses, your ESB bills, all that kind of stuff. The medium term is maybe the holidays, that 5 to 6 year type stuff, and the long term then is the likes of retirement. And for myself, is the children's education. So looking forward to those big bills coming down the line. So again, it's been they're my meal ticket. That's what I'm planning on. Just being a bit more savvy with things like that. I suppose I wouldn't be the type of person that would be telling you, God, you need to put away every single cent. Again, the life experience and being in different elements of business, you need to live for the here and now and let the hair down at times. And again, that's the good financial plan, and putting away what's affordable.
Yeah. And I'm just going to come back to the poll there, because there's a couple more people joined into the room there. Good morning to you all. We have a poll running at the moment, and the question was, what are you most concerned about? We have 66% of people now. Everybody might not have answered just yet, but 66% of people are worried that they might be missing an opportunity. We have 0 about losing pension, 0 about losing investment, 33% about not having a pension, and that's about it. I suppose everybody, okay, where people are being drawn to it now. So we're down to 50% of missing an opportunity and 50% of not having a pension. So please use the chat facility to ask any questions at this point. But I am going to ask a couple of questions on behalf of people, and I'll be completely honest about my own situation. So no kids and no pension, but I have critical illness cover. But I suppose for me, like 42 years of age, I know I don't look it, but not having a pension is something that I'm concerned about. But then you're like, about the affordability of it and how much do you need? And because I haven't put away money for so long, do I now have to spend triple what I would have spent if I started it 20 years ago? And all of those questions. The other one is missing an opportunity as well, because if you are interested in investment, is it a good time to invest? Is it a bad time to invest? And I know you've got a presentation and you can cover all of these areas, but anybody else, if you've got your own questions from a personal perspective, please pop them into the chat or put them into a private chat if you don't want to put them into the public one.
I said the details will pop up at the end. People can have my mobile number. We can do Skype calls. If somebody doesn't feel comfortable, maybe putting up a personal situation on the likes of the chat. And the consultation is absolutely free, and there's no problem in having a chat afterwards or a later date.
Fantastic. Well, okay. Will we go into your presentation, Barry? I'll start it here for you. And again, everybody, please feel free to use the chat facility. We can't see you and we can't hear you, just for the people who've just joined us. So Barry, you can control or I can control, and over to you. I might interject you with, we have a couple of questions along the way.
Perfect. I'm going to try and control the slides. We kind of see what happens. I suppose what we're really going to is a couple of points going to touch on today. I suppose what we've seen in history, and I suppose there's any scholars listening. I suppose my history teacher would have told me history repeats itself, and exactly what we're going to touch on here today. And no, Circuit team, we're going to have to get you to control the slides. I'm going to use the Zurich presentation. I suppose as a financial broker, yes, I am open to all companies like Irish Life, Standard Life, Aviva, and so on. But I suppose the last couple of weeks we have been doing a lot of seminars online, and I just used the Zurich ones. So I'm not favouring towards one company. A couple of key messages, as you see there, over a 10-year period, the odds on losing on equities are actually 4%, and over the last decade, by missing the best 10 days, you'll see quite a significant difference in gains. Bear markets and bull markets, a lot of people will be hearing things like that. The bear market is obviously on a dip. A bull market is obviously on a high trajectory and things going up. We are coming out of the longest bull run in history.
Really?
So again, we're going into a bear market, and I'm just going to kind of touch on what we've seen from history and roughly how long those bear markets last and what that will actually mean for your potential pension or your savings plan. And just when we say investments, it sounds, you need to have 100,000 euros or something to do this. It's not. I mean, my own investment is the savings plan for the likes of the kids' education, which is putting away a monthly amount now. So that money is there to pay for college education fees when they pop up. And then looking at the downside, will it pass? Yes, markets are in a period of significant volatility. And again, we'll show that just the ups and downs. And however, we have seen the monetary and fiscal measures emerging. So the likes of the US Fed absolutely throwing money out there, the furlough system in the UK, and here we have our own COVID-19 payment for people that are after being affected by employment. So when I suppose a market took a shock and we would have seen the likes of prices go down, governments are basically throwing money out there at the minute. So that's kind of seen it rise back again. So we can move on. Sorka, sorry.
No problem.
Should we be worried? The role of Roisin.
Sorry. Should we be worried about that yet? Or like, I know everybody needs to take these supports and whatnot. And is that just something that we have?
Yes and no, Sorka, is the answer. And I suppose I'm just really going to pick on you in this sense. I mean, if we put yourself in a pension, in a retirement, to God, my pension's after dropping by, I'm just going to take one of the figures here, 12%.
Yeah.
Does it matter at your age? No. Because if you go with the normal retirement age, which is 65, you have 23 years to go.
Yeah.
So today, no, it's not a massive concern. And again, it's coming down to the plan and what the plan is and the retirement and how long we have to go. And we'll see the timing versus time in. But just to get to the extreme volatility we're kind of seeing at the moment, as people can see, these are not months, these are days that we've seen in March, with percentages going up and down. And again, just looking at the very first one, down over 7%, and the next day it was up 4%. Like, usually we see these.
Just gone, is it?
This is March just gone, yeah. I suppose usually we might see this over a couple of months period with things going up and down. But it's very new with the likes of trade wars with China and
American presidents.
Tweets going here and there. But obviously this coronavirus is wreaking havoc with things up and down. And as you can see, you're just seeing a lot of ups and downs in the markets, and I suppose with the governments worldwide putting measures in place, that's again giving confidence to things. And I suppose very recently, just the oil prices were causing a little bit of panic. To kind of maybe step back from it for a moment, that's one company.
Yeah. And
from my understanding of it, you know, they have orders to fulfill. Yeah. And they need to get their barrels of oil out. So there's a new order coming in next month and the month after and the month after. So this month they're panicking and maybe kind of giving it away very, very cheap. Sorry, we'll move on to the next one.
Sorry. Bridie just has a question there, Barry. We have a second house that has considered selling, but if we can struggle through the low rent and finish paying the mortgage in 3 years' time, would you consider this a good investment?
Again, it's going to come back to the plan. Really, it's for Bridie, it's kind of going, well, what's your plans down, or when are you looking to retire? With the likes of properties, they're on an edge. You know, we've seen it going back from 2008, how low house prices were. And to give an idea, I suppose, let's go back to that 2008, 2009 recession. I'm not too sure, and people can correct me here. It probably took 10, 12 years longer, and we're maybe getting close to it now for house prices to get back to where they were at that time. Now, for me, if you bought a house then to live in, does it really matter? Are you going to look in 25, 30 years and go, God, if I'd waited 2 years more, I could have got it a little bit lower, a little bit higher? You were buying a family home.
Yeah.
And I don't think that, but as an investment, yes, that little thing will eat away. God, if I waited 2, 3 years, I might have gone up or down. But look, kind of comparing that back to the likes of stock markets and equities and things like that, they would have dropped by over 40% in some cases. And we would have seen probably about 16 to 18 months for those to recover, to get back up above and beyond where they were.
Yeah.
But for Bridie, I suppose, Bridie, we need to know a little bit more. And I don't really just kind of go, yeah, buy, or sell. It's how it fits into your lifestyle and what you're going to be doing going forward. And I suppose, how
What
long
your end goal is.
what your end goal is in, and by waiting a little bit of time before selling a property, and then we got to look at the tax implications that may bring as well. And just jumping back to the recession is the big word that's kicking around now, and everyone's going, God. A recession in financial terms is the GDP being at a negative for 2 quarters, and that's what brings us into a recession. So just to let people know, as you can kind of see here, here's the number of recessions over the last number of years, going back quite a long time, and what were the key contributors to it. Some might have been just the likes of oil, some would have had 2 or 3 things. The COVID-19 or this health crisis is unseen. It's never been seen before. So it's completely uncharted waters. We've never experienced this before. So that's when we're talking about recessions, we really don't know. And the best of investors and the all knowledgeable people, they just don't know. It's as simple as that. So just to give an idea, I suppose, on the recession, so we'll move on just to the next one. Sorry, people, if you think I'm jumping at you, I'm a mover and fidgety person.
As a mover and a shaker.
Yeah. So looking back at the recessions, and I kind of looked at this earlier, and I kind of thought of my parents. I'll try not to give away their age, but they've seen 8 of these recessions, maybe 9. Yeah, I'm not a great son to have. I don't even know when they were born or how old they are, but they would have seen 8 of these recessions. So as you can see, the year, how long it took to recover, and what the minuses were, what the drawdown was. Looking back in 2001 is not one I can massively remember that well.
I don't either.
I think I was in school, but looking at that, weren't. I mean, it's probably nearly the highest downturn, and I don't really remember it that well. Obviously, 2008, yes, but I know we're going to look at just kind of looking at those figures. How will that affect the likes of pensions? And we'll see that later on. Oh, sorry, I think I can move it. Sorka, hold on. I'm back.
There you go.
Control.
Just a quick one there. I know we're moving on, but there's two questions coming in. One was, can you explain the difference between monetary, financial, and fiscal? That's a good question, because they are all about money, are they not? So what's the difference?
Essentially, yeah. And I suppose it always comes down to the same old thing, supply and demand. And that's what we've seen with house prices recently. I suppose why are rents so high? The demand is huge, or was huge, and the supply really wasn't there. So that again was a driver up. And the fiscal again is down to, I suppose, the GDP and what a country is producing, and where a country is themselves in kind of profitability. And I think it was last year, Italy's, I suppose, GDP would have been 0.01% of a plus. I mean, it was an eyelash away from recession, or being in that, and that was never spoken about. Financial markets, things going well, and the monetary is again, look, it's just down to money. And we have seen the oil, the industry we haven't seen in quite a long time.
Yeah. Okay.
So sorry, I'm going to jump on.
No, you're fine.
Sorry, we went back. Sorry, a lot.
I did. Sorry, yeah. Bridie just wants to top up. Sorry, Bridie. You go, Barry. Bridie just wants
to
go
ahead with the question. Yes, no
follow up on the pension question. So she has a small pension investment, retiring in under 10 years. So thinking, hang on to the house, as have had difficulty in selling it without a big loss. So in 8 to 10 years would have a lump sum that could not save in the interim via a pension.
Yeah, I suppose, look, that again is the kind of thing that frightens me with property, is how much it can go up and down quite quickly. And as we go on here, and there's no problem, like I've no problem if someone's going to get a property, and it's, I'll always say diversify. And if you find yourself, I suppose, maybe in a lucky enough position where you can go get another property, yes, absolutely. Different eggs and different baskets.
Yeah. Yeah.
But as we kind of see, as we'll touch on through the presentation here, what we're really looking at, I suppose, is investments, and a pension is an investment. And we'll just kind of see, I suppose, how markets have responded and how over time, realistically, you don't lose in a pension. It's really, really hard to lose in a pension. And like I said earlier, time in the market and timing are two very, very different things. So just looking at this here hypothetical situation of, sorry, you're going to see dollars and euro signs all over the place here. But I suppose looking at investing 12,000 euros every year over the last decade, and where that would come from, be the likes of business owners in maybe a limited structure, or the self-employed, where they would make a lump sum contribution to the pension when we come to do tax returns. And just looking at it here, if you were super lucky and you invested at an annual low in the market, so when we have a dip, when the cost of buying things is much lower, you would have seen over double return on your money if you caught that market at the right time every single year over a decade. The 1st of January is obviously a time, I suppose, it's really around the likes of returns and people doing their end of years and putting in lump sums into the likes of pensions. And you see again for the 120,000, you would have seen quite an uplift on that. Unit cost averaging, which we'll go into maybe a little bit further, but that's doing it monthly. So if you were doing, let's say, 1,000 a month on a pension, and your contribution would have been an outlay, let's say, of 120,000, that would have been the return there of 219. Moving on then to kind of being very unlucky and catching the markets at a high, you still would have been up quite a significant amount. And then the last one is just the cash. So by keeping it in the likes of the credit union or on deposit in a bank, you see very, very little growth. And kind of the thing in relation to that again, I suppose, going back to the initial 12,000, does it have the same buying power as it did then than it does 10 years down the line? And the answer is going to be no. So sticking with cash is not necessarily the best option. And see, moving, I didn't go too far. Moving on then, again, trying to time the entry points is very, very hard. And again, looking over a 14-year period, I suppose where that would come in would be like the savings plans, where you might have some extra money and you just want to put it away for that rainy day. You want that money to work a little bit harder. Or, so to give my own situation, is kids going to college and, no, it's less, 10 years. But in 14 years' time, so by putting in 10,000 euros in 2003, if you left it fully invested and didn't touch it, didn't take it out, you would have had a nice return there of 18,000. By missing the next one here, by missing the best 10 days. So by taking money out, by missing those dips in the market, you would have seen quite a significant drop below the 10,000 and so on with the 30 and 50 days. And just a little point on the side there, as it kind of says, by missing the best 10 days in the market, your investment returns would have been 48% lower.
Now, just explain this to me just a little bit. So if you're saying that I started a monthly contribution to a pension on the 1st of January 2003 and didn't touch it until the 31st of December 2017, that 10,000 would have become 18,000. Is that what you're saying?
Yeah.
But if I didn't put it in until, say, the 12th of April 2003 and put it in till the 31st of December, I would have missed the first 3.5 months of 2003, so I could have missed the best days. Is that what you mean?
Yeah, you could have missed the best days over a period of time. Now, I certainly don't remember what exactly were those best days over that 10-year period. But what I'm trying to highlight here is often is putting it in on a monthly basis. Don't miss out on those best days.
Okay.
And again, it doesn't have to be 10,000 euros every single month. I mean, we're just talking about regular contributions that are affordable to you.
Yeah. So is there a minimum amount
that.
you need to pay?
Different companies will have different minimums, but I mean, like if you're talking 100 euros a month, you're absolutely fine on the likes, be that a pension or a savings plan. Some companies might take a minimum of 50 euros a month on savings plans. There's again, we're not talking massive money, or you have to be a multimillionaire to be making investments and doing savings plans. Absolutely not.
Yeah.
And again, just on those best days, we kind of, as we move on, we will see how they're affected. Just to look at equities. Equities, let's just say now, are like the blue chip companies. With most managed funds from life companies, you will have some shares in the likes of the blue chip companies, the Facebooks, the Googles, the Amazons. You're going to be in different sectors, I suppose, technology, medical devices, pharma, energy, farming. It's going to be well spread. You're going to have a quite diversified portfolio within many of the managed funds, whether it be with Zurich or multi-assets with the likes of Aviva or Irish Life. So you're not just in an equity, like all of it in Facebook or all of it in the likes of Amazon. But just looking at returns here, where our markets have fallen by 10%. As we can see in the very first one, after a year, it returned, it was up 11%. I suppose from the initial downturn of 10%, over a 3-year period, it would have been up 11.86, and so on with the 5 years. So as you can see, then just on the returns where markets declined by 15 and 20%, just really showing here that they do recover. Large falls recover quite quickly. Where this can become a problem is sort of, look, if you're about to retire tomorrow and you're highly still in equities, and we kind of had the March we had and we see a sharp fall. But as you come closer to retirement, we should be moving away from equities, kind of safeguarding what we've built up. It's not about profit at that stage. We're coming to security. Retirement. It is, absolutely. And again, everyone is different, and it comes down to the individual. Some might have more appetite to stay in equities longer. But I would always advise, as we're coming closer, maybe that if we just put an age on it, that 65 was when you were planning to retire. We're now at age 60. We would start looking to pay more
attention.
Absolutely, move more into the cash and bonds, because now, at the moment, for you, Sorkin, this isn't a retirement. It isn't a pension pot. It's a tax-efficient savings plan, and I'll show some examples on that. But as we get closer, it now becomes more real, and this is the money we're going to be depending on for how long we live and the remainder of our lives. So yes, we do want to look to safeguard that and not take big risks.
So the just the recap on that is, if don't worry too much because the market is declining, because over a period of time, even if the market is in decline, you're still going to have a decent enough return.
Absolutely,
over a period of time.
And just a little bit further on, we look at that on how it affects pensions with tax relief. Just taking a snippet from the market here on September 18 up to February 19. What the real message here, as you can see, a lot of lines squiggly going up and down, and that's typically what a market can look like. Why is it better to do it on, let's say, a monthly basis, or drip feeding it in, as opposed to, having a lump sum and waiting for the end of the year and popping that in? And just looking at this. So now what we're doing is, here we have our money and we put it into our investment or our pension pot. You no longer have money. You now have what's called units, but those units have a value. And just looking at this example, by putting in 30,000 back in September 18, you would have bought that amount of units. And to kind of fast forward to February 19, the 6-month return would have been minus. But also, let's bear in mind, if we're looking at the likes of pensions or savings and investment plans, these are typically at least 7 years. So we will see drops, and they're not to be concerned about. But if you're thinking sitting at home, I may have 10,000 euros in a bank account, I want to jump on a stock market. For me, absolutely go somewhere else. I look at, times and plans and over horizon, and what is the goal we want to achieve and when do we want to achieve it. And that will put us on the path on where we're looking to invest. But just jumping onto the unit cost averaging, if we were to do the same amount and maybe break it out over a period of months, as you can already see, you're after getting more units. And you just see the little red dots. That would be, let's say, your money going in and picking up the units at the time. And just jumping, you would have had a few losses along the way. But looking at January 19, it would have been a low in the market. And obviously then jumping on to February, then all those units you would have bought in January have now gone up in price. So as I can only see my face and your face, I think it's a plus 3%. Am I right? Over the 6 months, 3.7?
I can't see it.
I'm nearly positive it is. I think it's about 3.7. So that's the benefit of unit cost averaging. And again, I'm just going to move on. We have seen a tough March. So for a pension investor, looking at, a higher rate taxpayer, you get 40% tax relief. So looking at that, a 35% fall, you're still in a positive territory, being a higher rate taxpayer. And I'll just kind of show a contribution to that. Looking at putting 166 euros into a pension fund on a monthly basis, the net cost to you is 100 euros. So as you can see, you have a 66% return there straight away.
Wow.
And just going to jump on, because I remember one of my first presentations at a pension for a company I worked with very, very long time ago. They would have given, if you're on this amount of salary and if you're on that amount, and I was kind of going, I'm not on any of those up on the board. I don't know where I am. Where do I fall? So for a low rate taxpayer paying the 20%, again, you can see it by putting 125 euros a month into your pension. The cost to you will be 100. How does that work? Revenue will give you back 20%. So the 125 going in, revenue owe you 25 euros.
Okay.
And for a PAYE worker, they will see it straight away in their pay slip. For the self-employed, you're in a credit. So when you come to the end of the year and you look at your pension contributions, how many did I put in? This is what revenue owe me, and we'll knock it off our bill with revenue. And again, as you can see, from a higher rate taxpayer, by contributing 166 euros a month, the actual cost to you is 100. So people that may be on the edge of a 20% payer going into 40, as you can see, you're putting another, practically 41 euros into your pension every month, but it's not costing you a single penny more. You're just taking advantage of the tax relief that's available. So as we talked about the massive losses and things going down, as you can see there, you're in quite a positive by pension funding. As a lot of people say, God, I'll die before I get to spend that money. Here's a couple of statistics that might help you think otherwise. So looking at men today, so for age 65 today, the chance of living to age 80 and 90, look, people can see the percentages there for men and women, and as a couple, they're quite high. So anyone hitting retirement today at age 65, why is it important to fund for a pension? Well, you've quite a long time to live.
15 years.
As I kind of put it, what you do today on a Saturday is what you'll be doing every day in retirement, and what is going to fund that, whether that be golf or gardening or whatever it is that you do on weekends. That's going to be you every day.
And I hear that the state, they say the state pension is going to be gone by the time, say, you and me get to retirement age. Is that right? Or
I'm going to quote.
What does that mean?
I'm going to quote a US president here and say fake news. We don't know, Sorkin. That's the truth. Myself personally, my own personal view, we've seen it increase from age 65 up to 67 and 68. We've kind of seen that bit of a phase. I see it going to 70, but long term, is it going to be there when you and I retire? I don't know. And I don't think the state can afford to have it there. And that's a personal opinion.
Can they afford not to have it there?
God, can they afford to have it? Really is the question. Can they afford to? You'll see a quick Google will see how many people from today will be age 65 in, X amount of years. So how many people is that going to be looking for state aided pensions? The numbers is well over 1 million. So yeah, is it going to be there? I don't think so personally. That's a personal opinion on it. I'm not going to give a guarantee or say I have an eye into the future and know that this is going to happen, but certainly we don't know. And the COVID-19 is obviously going to change things around again, and how governments are planning. But just looking at the time horizon is important. So as yes, you will be hitting retirement, you've quite a bit to go after retirement, and why funding a pension is important. Jumping on to some tips, I suppose, behavioural. Looking at the loss aversion. Yes, you open up your pension statement today and you see 3 weeks ago it was worth 100,000. Today it's worth 80,000. Doesn't look good. No, none of us like the feeling of it. So some people will go, I need to get out of those equity funds and I need to go in cash. In most cases, that's the wrong thing to do. But again, we got to assess where you are. If it was you, circa 42, and your fund went down by 20%, we have a long time to go. So absolutely do not panic. Again, the loss aversion, it does lead to insufficient risk decisions. So the likes of those losses do behavior analysis. No one likes making losses, so we do look for change. We look to pre-existing beliefs and we recall information selectively. And the kind of one here I see is you want to believe, you will. As someone said to me a long time ago, if you believe you can, you can. And if you believe you can't, you can't. So again, the mindset, really just taking on the mindset. And it is going back to maybe your financial advisor you originally met with and going over the plan again. Like, when am I going to retire? How long have I got to go? Again, the herd mentality is listening to people. And I'm sure a lot of people here are probably sick of the WhatsApp messages we've been forwarded about don't touch diesel pumps. If the cat had kittens, this is going to happen. Try and get it from a reliable source. And, the herd mentality, the listening to the peers, my friend is going doing this, it leads to an emotional rather than a rational decision, and poorly timed decisions. And again, the poorly timed, just looking back at some of the stuff we have seen, by moving a pension at the wrong time, by moving from equities into cash, are you doing it at a wrong time? And again, the irrelevant data. So there are just some of the tips to be aware of. More, stay disciplined. Stick to the plan. Cash is not the long-term answer. Again, time in the market. How long have we got till we need that money? I suppose if the kids are going to college next year and you have 10,000 euros in a credit union account and you decide, I want to go into an investment. For me personally, I wouldn't like that at all. It's just way too risky. So how much time have we got in the market? When do we need that money? There's going to be a lot of volatility. It's part of investing. Things will go up and down over the long term. The risk will outweigh, or the rewards will outweigh the risks over the long term. And again, diversify. There's lots of different funds out there. There's so many things we can look at. To purely put it on a risk level, we kind of come up with numbers. So from 1 to 7. So you can put little percentages into each fund. And the likes of people like myself can advise you like that. But I like to pretty much look at it on a human level when you're looking to retire, rather than going, how much do I need in retirement?
Yeah. And you can always chat to you or somebody like your financial planner about how to manage the volatility so that when or if it does happen, that you're not panicking because you already have your business continuity plan in place, for
Absolutely.
example.
Look, even as I say to my clients, talk to another financial advisor, talk to 2 or 3, and go with the one you feel is, I suppose, is listening to you best, understands your needs. I suppose I would be very equity based, and I'm a risk taker. But that mightn't suit you. By me forcing you, Sorcha, who might be, let's say, very risk adverse, I don't want to be pushing my opinions onto you, and that you should be, you're mad, you need to get into equities. So we just need to inform where's the best information, which person has given you the best information and made you most comfortable. That is the person to go with, in my opinion.
Yeah.
Again, like the car insurance, we all ring around the 2-3 companies and see what the best quote we're getting. Be the very same when it comes to financial advice. Get as much information as you can. What I've found with people is they may have met someone before me, and then you come in the door and we're having a chat, and then you kind of get some of those questions. You're kind of going, whoa, where did that one come from? But you obviously know that you've been talking to someone. And for me, I love those questions. I love someone that's gone around and maybe met 1 or 2 people, has got some information. And as always, look, if we put a pension in place, let's not forget yourself to look at it every year. Most advisors will ring every year to check in, see how things are going. For me personally, it's not about trying to get more money out of you and get more money into the plan. It's not that dreary phone call. Take it, have a chat, and be disciplined yourself. If you don't think you can afford to put more into the plan, don't be led by someone else. Don't be led by the likes of me telling you, God, you got to put more money in. Any good financial advisor and planner will know that. They'll know your financial circumstances, know what you can afford.
Yeah, because there's no point in saving for tomorrow if you can't actually live today.
Absolutely, and there's a bit of that as well, Sorcha, 100%.
Yeah.
It's all well and good planning for the future.
Yeah.
And it is very, very important. I suppose something we've all become more aware of, and definitely since COVID-19, is mental health. You need to live for today. You need to enjoy the things today, whether that be a sports activity, whether it be going to the pub, socializing, or nice meals in a restaurant. I certainly won't be telling people, God, you need to cut out that nice meal you go for every month to fund for a pension.
Yeah. Sorry, I'm just conscious of time, so
absolutely. Look, that's really it for myself.
That
there's the contact details. If there is questions, I'm more than happy to answer them. Look, just come back to 1 or 2 of Bridie's things, because I don't know an awful lot about Bridie personally. It can be hard to kind of say, yes, sell it properly, don't sell it. It really comes down to the individual's needs and what their plans are, and what appetite they have for the likes of risk. And as we always say, look, if someone says to me, I'm going investing in stocks tomorrow and I really like this new, let's take Zoom, was one of the new companies. Yes, have you an appetite, or have you the stomach for that to drop by 20, 35% tomorrow? If you don't, that kind of investment is not for you. But as we kind of hope I shown in the presentation, is that over time, and especially with pensions, it's very, very hard to lose. And people go, well, I remember 2008. You got to look at it in a different context. Yes, it was probably worth an amount of money, and when people went to cash out, that it was worth less. But how much went into the fund, and how much tax relief did you get from that? And when you compare that figure to the end figure, there is quite an uplift. But yes, absolutely. Of course, someone may be looking at a pension fund of 300,000, and when they went to retire, maybe it was worth 50 grand less or something. That's not nice, and nobody likes to see those losses. But again, it really comes down to what we've seen from the markets. If you find yourself in that situation tomorrow, can you wait 18 months or 2 years? To take, to wait to come back to that pension. I think that's what it was missing a lot, advice-wise, back then. And let's not forget the lessons we learned from history. Let's learn from it. So someone in that situation today, that's maybe after being affected by the downturns, my number one go-to is, do you have to retire today? Do you have to take that fund? Can you wait 6 months or 12 months to maybe come back, and let's give it a bit of time to recover?
Okay. Well, I think it was really interesting, Barry, what you shared with us today. And I think for me, anyway, it was kind of giving you a little bit of reassurance and peace of mind that if you do have an investment out there, that all is not lost, and stick with it and look at what your end goal is. And if you don't have a pension, you need to start thinking about having a pension. Yeah.
Look, absolutely. And just looking at one contribution, and we'll just take the higher rate taxpayer, you put in 166 euros into an account, and straight away you're getting 66 euros back into your hand. But there's still a value of 166 within that. I mean, if we were to open a shop and I say, come in and spend 166 and I'll give you back 66, and people would run in the door. The pension thing, it's just longer term. You know, it's a tax efficient savings plan until we get to the actual retirement stage.
Makes sense. Listen, has anybody got any more questions before we sign out? I'm conscious of time that we went over, and thanks for everybody for sticking with us, but it shows everybody's interest in what you were
hopefully put a bit of excitement on a boring subject.
I don't think it's boring at all. I think it's really interesting. So if anybody has any questions, if not, Barry, I want to say thank you very much for your time. It was greatly appreciated, on your support for the Train Down webinars. And if anybody has any questions, pop them into the chat, or there's a direct link there in the offers section where you can register for a free consultation with Barry as well. So thank you very much for having me. Your time.
Thanks everyone for listening and the time. And yes, look, if you have any questions, you can contact me directly. There's no problem there.
Fantastic. Listen, we're going to sign out now. So thanks very much, everybody. And thank you very much for your time. And Barry, we'll chat to you soon.
Thanks,
Bye for now.
Pleasure. Bye for now.
Bye.